The S&P continues to march higher and higher. How much higher can we go compared to other times where we've marched seemingly every single day higher and higher again before we ran out of gas? So I'm going to kind of take that look back and show whether or not it makes sense that we can make a run towards that 2800 level, at least in the short term, and if and when any kind of pullback will come and how far down we may go. So we're going to break all that down in today's video as we head into a new week with some earnings announcements, especially some bigger names across different sectors. One stock that's doing particularly well these last few days, kind of starting a new bullish trend and giving us a good swing trade opportunity right now, we're going to break down for today's trade ideas. So let's go ahead and get started. Today is Monday, February the 4th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, as always, let's start off with the S&P 500 on the market forecast, looking at the market forecast indicator. You can see, fourth straight day to the upside. We've gone in the last 4 days. We've gone from 2640 now up to 2725, so almost 100 points, making that march towards 2800. I believe now the momentum is strong enough. We've broken through enough areas that we're kind of potentially on an unrelenting march up towards the only other major high point left before we hit the all-time highs. So, whether or not that's a good thing or not obviously remains to be seen. But the reality is, we've been up in the last 27 trading sessions. We've been up 20 of those days since the Christmas Eve low point. So that's almost 6 weeks there, including a day off there in January for Martin Luther King Day. As a result, the posture has gone from strongly bearish, about as bearish as you could be from an intermediate standpoint, because of the cluster of clusters, 6 in a row. And it's not very often we get that many clusters, oversold clusters consecutively. And from, in each cluster, before the clusters, we started at 2600, which was an important area of support. Well, then we broke through, and with each successive cluster closed down to 2350. So we lost 250 points with each one of those days. Obviously, we've since rallied, of course, and you've got all the lines I've talked to you about before on Friday. In Friday's video, you can see that if I were to add on just a few more charts here, a few more bars off to the right, here we go, then you can see where the cycle suggests that we may pull back down towards by the end of by post in this area around February expiration, around this 2575 area, where the Fibonacci fan is crossing the 38% Fibonacci retracement at the same level as what would be the retracement of any move from the Christmas Eve low point. So, that's kind of our target area there if and when we ever do get a pullback. Of course, at some point in time you will. The intermediate line will come down at some point. And the fact that it's gone up without that hiccup, right, without the retest, and the more it goes up, of course, that's a 5% move just to get down to what would be just a 38% retracement. That's a pretty decent move to the downside, but it's only a 38% retracement. And again, it's because of how much we're moving in such a short amount of time right now to the upside. Of course, you have the rising moving average and the dark green combination. It didn't start out that way, so that's why it's a little suspect. But you have it now, and that's a bullish combination. You can see long-term market sentiments rising. It's not quite, even really above the 40th percentile, much less the midpoint of the chart, and that's when you really start taking off on your long-term trend. We'll see if that happens here on this current intermediate run. The near-term line has been above 80 for 3 days, above 50 for 4. 7 to 12 is your typical time frame when your intermediate line is already above 50. So we'll keep our eyes out for that typical time frame and whether or not we are able to get that. It looks like more than likely, unless we get a really sharp sell-off in the next day or two in the near-term basis. And I mean sharp, like maybe back down to 2650 in that area. Not like all the way down to 2400. But if we get that kind of a pullback, that will bring the near-term line down pretty quickly. But more than likely, considering the bullish momentum, if we ever do get a pullback, it's going to be a little slower, kind of like this, how we had over here, where we went up for a few days and then we kind of messed around before finally pulling back below 50. More than likely we'll get something like that with the near intermediate line again already above 50. You can see it's very same pattern going on the Dow Jones, not quite as bullish in the near-term basis, but still pretty bullish there. The Nasdaq also showing the same pattern. Again, not up above 7,500. That's the key level there. 2,600 is the key level for the Dow. And then, of course, this like 1,550 to 1,600 area would be the equivalent level for the Russell 2000. Those are all equivalent to the 2,800 level, excuse me, that we'll be watching for on the S&P 500. Now you notice the Russell still is the only one that's gotten that overbought cluster yet. None of the others have quite gotten there, even though you've got two of the three lines in the overbought. So we'll see if we end up getting that a strong enough move with a big enough range to get the red line up above 80, because that's what it would take. And you see that's what we got on the Russell 2000, 2 days worth of relatively large ranges, closing right at the highs that got your momentum line from nearly oversold to overbought and producing the cluster. Now again, really quickly before we look at some other charts, a reminder, subscribe to our YouTube channel. You can do that by clicking the red subscribe button over here underneath the video on the left. You can also mouse over our logo in the bottom right corner of the video and you'll click that red subscribe button that pops out. Also, click this thumbs up icon. That lets us know that you like the video, number one. It also tells us, number two, with one click, that you want us to do the video again tomorrow. So every time you click that thumbs up, that's telling us that you like the video. It tells YouTube that you think this is a good video that they should promote and share with others. Again, any engagement, whether it's a thumbs up, a thumbs down, and comments are good for the video to be promoted on this particular channel. So like I said, if you don't like the video for whatever reason, the worst thing that you can do is not click on anything, because engagement is good, whether it's quote-unquote positive or negative engagement. And as I mentioned, comment down here, comment on something you got out of the video today, so when people come across the video, they can see why maybe they should check it out as well. Also, if you're watching here on our blog, remember to click this heart underneath in tonight's Market Outlook tweet. That opens up a new window. You can like it. Again, same thing. Lets us know you want us to do the video again with one easy click. You can do it right now while you're watching. Also, click this image. That will take you to your Facebook page. You can like the Facebook post and share. Now, the thing with Facebook and Twitter, remember, is the more you click on those, the more you're telling those platforms that you want them to always show you our stuff, because that's not always the case. Even though you follow us, you still might not be able to see all of our stuff, because it depends upon the algorithms that they have. So make sure you do that. And of course, also you can subscribe to our channel or to our website here for free to participate in our Market Outlook forums. You can do that by clicking on this image. It takes you to this page. You can see a really easy form here to fill out to subscribe to our site. Alright, back to the charts. You can see we've broken up above last week's high as of right now, but we've also broken above the 200-day moving average. We have a rising 50-day moving average. Of course, the gap between the two lines is shrinking, still negative, but it's shrinking. If you take a look, at the other major indexes, the Dow is obviously a lot higher. In fact, it's actually a lot closer to a golden cross than any of the other indexes. Just like that, the Nasdaq Composite's above its 200-day moving average now this week with its move, and the Russell still is below its 200-day moving average. So keep that in mind, that we're not quite there yet on the Russell. It's the one that's had the biggest sell-off, the biggest drop down, and despite this nice little rally it's had to get to this point, and not quite all the way back yet. If you take a look at the three green arrow chart for the S&P, you can see obviously we've got three green arrows. We're still easily trending up above the 8-day moving average, the rising 8-day moving average. Something to keep in mind about that. I've changed now the MACD down here to show how far away we are from the 8-day exponential moving average, the green line. The blue line tells us the absolute value between the current closing price and the 8-day. And you can see we've been higher over here. This is, we were up higher just recently. Even over here we were above the 8-day pretty far up almost 40, 50 points or so. Same thing over here, and you can see what happened when we were this far above, what happened afterwards. Over here, we hit an extreme. You can see what happened there. In fact, here, let me put on a drawing, a horizontal line. So give me 1 second to do that. And we'll put that horizontal line right at, what is it, 42.50? Right where we're at right now. Alright, you can see, you know, there's been a few other times over here. We got up that far up above the 8-day, and then we kind of flattened out. And a little bit higher there. The index itself was a little bit higher. Same thing about right at current levels. This is as far as we got up above. Same thing over here. Again, right at current levels. We got this far above the 8-day, and you can see what happened afterwards a couple of other times. And then finally, this period of time, we were similar to where we're at now. We've been above the 8-day at these levels for a while, for an extended period of time, for a good long, and just completely above the 8-day when the blue line gets above 0. You can see how long we are. So it's not really the most healthy to be above the 8-day for a long period of time. I mean, barring this one little dip that we had right there, we were above the 8-day for a couple of months, and that just again shows just how extreme this was, and then what came afterwards, and then again over the last 2 years, nothing more. You can see how more volatile things have gotten in the last year versus 2017. So this kind of goes to show that this may not be the best thing, that we're this far up above the 8-day moving average. And if I were to show you the same values here for not just the 8, but let's just go to that 30-day simple moving average, the dark blue line on the chart. So we'll add that in here. So again, we are now farther up above the 30-day moving average than we were over here in January. So very, very high levels, very overextended levels for the S&P 500. And you can see the stochastics, at least, telling us to keep an eye out for bearish divergence, since we're already up forming higher highs that correspond to what could be lower highs in the stochastic. Alright, as I mentioned before, this gap's going to start shrinking because we'll start moving this low point up tomorrow and the day after that and the day after that for a couple of days, and then the day after that, a couple of days after that for a couple more days, and we'll eventually move it all the way up to this level here within a week or so, a week and a half, up to 260. So depending upon how far up above these new highs we get, in the meantime, we're going to move what is currently close to a 10% 4-week range to well under 5% that fast. So it kind of shows how, you know, as we head into some resistance areas, as we already are at resistance and heading towards others, how quickly things can shrink in terms of this range. There's the Hakunashi Open for this week, so the pullback that we can get, we can drop down to 265 really easily with nothing really holding us back from that. It would be nothing more than a retracement, and you wouldn't even be forming a lower shadow on the weekly Hakunashi candle. The last week's low points even below that. The 4-week range will start moving up into this area, so it will also, that will also offer no resistance towards a move back down towards 265. So keep that in mind. Volume is really lightening up, and the trading ranges are really getting smaller. You can take a look at today's range and volume here. Let's look at this chart and pull up SPY. Today's range at with no gap at 2.67 points, and the volume at 60 million. So put that in context. 2.67 is way down here. Below the average, below 1%, so moving this relative ATR down, and then the volume at 60 million is way down at the lower end of the 52-week range too. So very bullish number. I mean, that's not bearish. It's actually bullish, but you can see we're gonna really start slowing down the move that we've had because of how small these ranges and volumes are getting. On a volatility basis, you notice we are down to almost 15, just like that. We were just a week ago we were at 20. Last Monday, or the 25th, excuse me, we were right there at 20, and now we're back below 16. We're still not, though, below that 90% mark, which is the key levels. So in terms of like inventory trading, which is what I teach on Wednesdays, we are actually heading towards timing for good calendar spread entries. If you have a large negative vega, which typically you do when you're doing inventory style trading with a lot of the selling options that you do, this would be a good time to start adding calendars to offset some of that. It's a low probability trade, so the only purpose of putting it in there is just to give you that positive vega. But with volatility not breaking through that support yet and still holding it, and the expectation of near-term weakness that would bring this up, this would be a good timing in the short term to add those particular strategy to your inventory. All right, so with that being said, to summarize, the market's still strongly bullish. We are kind of getting to extremes in the short term, depending upon like what moving averages and things like that you look at, and divergences setting up with clusters on the Russell 2000. But when we start to pull back, obviously remains to be seen. Bullish momentum can be very strong until we flush out and make the pain trade to the downside, until we get everybody in one side on the trade. The market will still continue to cause the most pain, and still we haven't flushed out all the bears yet that have been hanging on. The pain trade still is to the upside in equities, and that with a big draw, with some big round numbers across all the major indexes, drawing us up potentially higher, at least in the short term. But the higher we go, the longer we hold our breath underwater, eventually we have to come up for air and we have to exhale. And the longer we hold our breath, the bigger that exhale is going to be. So it doesn't mean we can't enter new bullish trades today, because we just don't know when that exhale will start and when it will occur, and for that matter, how deep it will be. But just know that that's a risk factor that's out there. So any new bullish positions, especially in the short term you enter now, should account for that particular risk factor. That being said, what do you think? Do you agree or disagree with that outlook? Click that poll popping out in the top right corner of your screen, then hit either agree or disagree. And if you click disagree, scroll down to the comment section below. Let me know what you see that would suggest otherwise. Remember, also comment on anything that stands out to you on our videos. Remember, you can follow me on Twitter for more content like this in between videos day to day that we post out there, Brandon and I. Both of us have Twitter accounts there. And of course, join our Market Outlook community that we've created on Facebook. You can also join our daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. It takes you to a site to subscribe. Of course, if you go to our site for the first time, there's a pop-up window that will help you subscribe there as well. And anytime you subscribe for free to our site, you can also join our daily email list there. All right, now let's take a look at what's driving price action today. You can see commodities on both ends of the spectrum were positive and negative. Crude oil started really negative, down 3.5% this morning. At least the ETF that tracks the futures contract. Finished the day only down 1% though, so well off of its lows. Agricultural commodities also went up at the same time. They rallied from what was a small gain to a 1% gain. Small caps also a little late push to the upside at the very end of the day, up 1.25%, outpacing large caps. Developed markets outpacing emerging markets, so both were flat. So not really a whole lot of movement in the other asset classes outside of the dollar and gold. Obviously on the opposite sides of the spectrum, the dollar was up, gold was down, and then you can see long-term bonds were also down. So a little bit of a break. You can see if I were to take a look at the 10-year note, which has been pulling back the last couple of days, a little bit of a bounce there. So, and you'll see that reflected actually in the economic calendar, the economic surprise index. Look how strongly it's rallied. Not necessarily because, we did have a blowout jobs number relative to expectations on Friday. Remember, this is a rolling 3-month window of economic indicators, the ones that influence the currency, the currency here the most. And so keep in mind that, while we might not have had anything today, and there really wasn't, the only thing today was factory orders. Tomorrow we have services from the PMI and ISM. Later in the week we have trade data coming out, and that's really about the major thing. Powell, of course, speaking, and that will be highly scrutinized. But the biggest thing is earnings, right? We have earnings from the market standpoint. Disney is the biggest name coming out, and you have a few other names. Archer Daniels, from a staples perspective, Electronic Arts, something we've looked at before. That's tomorrow. And then on Wednesday, you can see Eli Lilly, Glaxo, SmithKline, GM, a lot of pharmaceuticals, Humana, CTSH coming out on Wednesday, and then finally on Thursday, the bigger names that are due from a consumer staple standpoint again, Philip Morris, and then of course Yum Brands. Twitter is due out on Thursday as well. Basic Materials and some more food companies, Kellogg and Tyson. Fridays and Mondays are typically light. Of course, we had Google today in the after hours, and it's really dropping. But on Friday, you have a couple. You have Exelon, you have Phillips 66. Those are, not really any other major names out. That's typically lights on Fridays and Mondays. So those are the big names throughout here this week. That's going to really drive, and we're soon going to start really lightening up on the earnings. We've kind of passed through the bulk and especially the bigger names within the S&P 500. And of course, all eyes are going to be on how this translates to interest rate hike expectations, which from one day to the next still are relatively low. I mean, they did rise up from what was 0% on Friday to 8% today. So a little bit of a jump in interest rate hike expectations, though still very low for 2019. This is only one hike. The odds for only one hike in the whole calendar year. And of course, it's about equal to the odds of a rate cut in the calendar year, which is also very, very low. And it's a little bit down from what it was on Friday. So eventually you would expect that this would translate. But you notice from a global economic perspective, we're still mired in this kind of global bear market. And that's going to be a risk factor that eventually the market will have to deal with. We didn't deal with it for a while, all in 2018 until the end of the year, and then we caught up. If you recall, when we looked at this list, for most of the year, the S&P 500 was the biggest winner for almost every single day. Whether it was an up day or a down day, it was usually up to the upside until the end of the year. And you can see it's still the same case today. You have a few others, Italy, Australia, Argentina, emerging markets, and a commodity base and emerging market there in Europe, technically. And then there's Taiwan, the only ones that actually outpace the ACWI. And then U.S. stocks, of course. On the other end of the spectrum, the other big emerging market names, Turkey and Indonesia, aside from Argentina, that have had the biggest gains and losses over the last 3 months, they were down the most, as well as France, Germany, India, China. So your bigger emerging market and developed market names, all with small gains, small losses. So all lagging behind the U.S. So keep in mind that while we've had a nice little bounce in risk appetite all across the globe, and things are looking really nice here in the U.S., you can see almost all the charts look exactly the same except for India, which is now down below a falling moving average. Not pink yet on the chart, but close to falling. It's down below. It is below 50, so as soon as it does roll over, you will be pink on the moving average, and that would turn bearish for that particular area in the market. Everything else pretty bullish, but not to the same extent, right? So you can see China is close to its 3-month highs. They're all relatively close. Brazil is the close. It's by far up above. A 10% gain. It's got the biggest gains over the 3 months. You can see South Korea also has some pretty decent gains for the 3 months, and so does China. Everything else relatively flat. But remember, they've had a bigger loss. If you take a look, a lot of them are finally catching up to their moving averages here. And I don't know why this one didn't take. Let me see what's going on with this one. There we go. And I believe there's another one right here that didn't quite take that 3. Let me bring this one up as well. There we go. Alright, so you can see a lot of them are still below these moving averages. You can see the declines that they've had for most of the calendar year, like in China before the U.S. finally had its decline. There's the UK really down from its peak in January. whereas the U.S. had peaked later in the year. China also peaked in January. Japan had peaked in January. Germany had peaked in January. So you can see, they're all trying to recover from those January peaks, whereas the S&P 500 already had and formed new highs and had some pretty decent losses. They're still not all recovering yet. China's kind of recovered the best. Brazil has really covered the best and is actually forming an overbought cluster right now on its weekly chart. So it kind of shows just how bullish it's been. Everything else has made a rally up to these declining 30-week moving averages, with only a few just getting slightly up above it. Aside from, of course, Brazil. Russia slightly up above theirs, and Korea slightly up above theirs. From a sector rotation standpoint, you can see technology, industrials, communication services, discretionary, all leading the market, very cyclical nature. Today, staples also kind of matching the market. Materials down below, healthcare, utilities, and real estate all lagging along with financials. So, it's a risk-on day with your safe haven areas lagging behind. But they haven't always been the laggards, as I mentioned before. They've been, there's real estate. It's got the best 3-month performance. And there's utilities also outperforming the S&P. And we would expect that to continue to be the case as long as yields pull back, right? We've had a 2-day bounce in yields. But the idea is the Fed's done with their interest rate hike policy. That hasn't in the past been a bullish event for yields. Usually yields will start to fall post rate hike cycle peak. So, but you can see a very typical pattern. If I were to go back to now the 2-week chart on this and take a look at who's been performing what. There we go. So this is the 2-week chart now, not including, this is all 10 days. 10 days chart because we don't have the holiday anymore, the Martin Luther King holiday. And there's real estate. While it's got the best performance, it's got a little bit of room to underperform for a little bit. Whereas financials, materials, healthcare, discretionary are all lagging behind. Technology, communication services are your better bets. Remember how everything's kind of been separated. Technology is pretty much Apple. Communication services is Google and Facebook. Google will influence that tomorrow to the downside, but Facebook had really influenced it to the upside last week, and that's why you're showing such strong gains. But staples, utilities, and real estate all leading the market higher during this 2-week run shows, again, kind of the status, the level of risk appetite that we're seeing. One stock in the software industry has really had a good few days here with the move higher in technology is Adobe, and Adobe is really close to that 260 area, which would be the equivalent to that 2800 area in the S&P 500. Nice little bounce off a short-term level. We've had a green line on the moving average, dark green shading on the chart. So good combination there. Strong bullish posture. You can also see 3 green arrows on its chart as well, with the MACD up at relatively high levels. The stochastic's got some room to run. If you take a look at it on the actual 3 green arrow chart itself here, with the volume down below, you can see a couple of days ago on this little breakout bounce, you've had a when it closed above all the highest closes, you had some pretty decent volume, and now you've got 3 green arrows, and we're trending higher again. A new 3 green arrow signal. From a long-term viewpoint on Adobe, you can see we had a golden cross after that brief death cross. We've had a golden cross, and it's pretty entrenched there, unlike the S&P as a whole. It is trading up above its upper Bollinger Band on this little breakout, and breaking out above this significant volume node that we're in right now. So a very positive technical pattern setting up here for Adobe. You can see when you look at the DMI with the other DMI indicators that we use in conjunction. Here, I'll pull up Adobe, sorry. You can see it's a cross up above 25. Both these indicators are both positive as well. So positive chart all the way around. You can see we can look at selling a 240 put in and of itself will give you about a 10% return on capital. right? You know, of course, your risk is $24,000 if you're using this in a non-margined account. But if this is a margined put, a naked put, you can see this particular account requires $3,600, so you have over about 10% of return on capital. So not a bad trade there. Of course, if you wanted to lower your capital requirement, it will also reduce your potential reward. You're looking at about $1.16 will give you a 30% return on risk. So it's also reducing our risk a little bit, but that will also reduce from $3,600 down to $400, reducing your credit from $400 down to $100. So you're getting about a 25% return on capital now, with a lot less capital required to get into the trade. Okay, that does it for today. Now I want to hear from you. So let's go to our forums on our marketscholars.com website. Remember, you can subscribe for free to participate in our Market Outlook forum, our free forum. Our forums and our classes are for our premium subscribers, so you have to subscribe to our site to participate there. But anybody can participate in our Market Outlook forum. So now I want to hear questions, comments, on anything we talked about in the video, anything we didn't talk about in the video. You can stir up some conversation there with other market scholars. Remember to like the video, click the thumbs up down below, comment on anything that stood out to you, and subscribe to our YouTube channel. Also follow me on Twitter for more content like this in between videos throughout the day, and join our Market Outlook community that we've created on Facebook, as well as obviously on our site at marketscholars.com. Have a great rest of your evening, everybody, and we'll see you all tomorrow.